Good day, everyone. Joel Solomon of PRS and the Roadmap in our continuing series of training on the web. Today, it's indexed life versus an alternative investment or a mix of investments. So let's take a look at, of course, everything that always begins with the proper disclaimers, that everything is based on the client's objectives and assumptions, and results are going to vary over time, and always look at the insurance company's illustrations for all guarantees, assumptions, and disclaimers. So let's think about somebody that has money in the market and or fixed income and is considering index universal life as an alternative asset class, perhaps to reposition some of their money in their low and moderate risk portfolio and some percentage of annual savings. So let's suppose that somebody has a stock portfolio, again, earmarked for retirement income purposes, and they're allocating it to the S&P, and they want to assume a 6.22% return that will be taxed all in federal and state taxes, capital gains 34%. Now, what's interesting about that is when you apply the 34% cap gain rates, keeping in mind the dividends that are typically part of the S&P are taxed at ordinary income at a higher rate. At that 6.22, we're going to assume that after tax going to be about 4.11. We're also going to assume here no investment expenses whatsoever, which is really not appropriate, because you're going to have to pay at least 60 basis points to be involved in the S&P, some type of mutual fund. Now, the alternative is we allocate these same funds to an index universal life policy, and let's just assume that the growth of the S&P is going to be at 6.22%. So let me show you where I get the 4.11 after tax if I was investing money in the market. So let's suppose that I had $1 million and I was investing it in the S&P. And again, let's assume that I could get 6.22%. Well, when you apply the tax rate of 34%, what you would end up with is, yes, you'd have growth of $62,200, but after you apply the tax rate, you're going to end up with $41,000 or 4.11%. So let's suppose I was a 45-year-old individual and I wanted to allocate $44,000 a year all the way through age 65, and then want to convert it to income on a tax-free basis for as long as I can during retirement. So there's my $44,000 going in the first year, my 4.11 after-tax rate of return. So I'm going to add 1806, so I end up with $45,806 at the end of the first year, I should say. Now here's $44,000 a year every year through age 65. So I've now, on a cumulative basis, invested $924,000. Now I can project, again, at the 4.11 average annual after-tax rate of return. We know that nothing is linear, but this is just to be able to compare apples and apples. So I'd accumulate just shy of $1.5 million in the S&P after tax. I then want to convert that, selling off the stocks, selling off the S&P, to annual income, and you'll see the income begins at $135,000, is growing with inflation, but at age 78, just 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, just 13 years into retirement income, I can only take out $88,776 at age 78, which means I've taken out $1.8 million tax-free to live on, and nothing is left at age 78. So we bifurcate looking at any investment for retirement planning into the accumulation phase, that is, the money is growing until it's time to take the money out in retirement, which I call the distribution phase. Now I'm going to take that same $44,000, I'm going to put it into an IUL policy with one of the leading insurance companies, and we're going to assume 6.22%. Now when you take into account current assumptions and that annual crediting rate, 6.22, just like we applied it to the S&P, less charges, less surrender charge, at the end of the first year, there's only $16,000 of cash surrender value and a $1 million death benefit. So allocating the same $44,000 a year for 21 years, the same $924,000, I would project an accumulation inside this policy of about $1.8 million. And again, about a $2.8 million death benefit. I'm going to start off with that same $135,000 that I'm going to pull out of this policy via withdrawals to basis and low-cost loans. Going to let that continue to grow with inflation. And notice that this income is going to continue all the way through and including age 90. $3.4 million came out completely tax-free. That's the equivalent of taking out $7.2 million from a 401k plan in the 40% bracket. Now the other thing to note, at age 90, I still have cash left over and almost a $500,000 death benefit. So now let's compare putting that $44,000 a year into the S&P at 4.1 after tax, 6.22 growth of the S&P assumed, versus putting it into the IUL policy at the same 6.22. Just to remind you, in the S&P alternative, that $44,000 getting the 4.11 is worth almost $46,000 in year one, compared to $16,000 of surrender value in the indexed universal life policy year one. So if your focus is strictly myopic, I would never allow, notice my words, I will not allow a client to own the indexed universal life policy, and I say that to them. I will not allow you to own it unless philosophically we are aligned that this is not just about accumulation of money pre-retirement. This is way more about the distribution phase, when you need to be able to have a source of income to live on during your retirement years. Assuming that's the case, and again, keeping in mind that the index policy generates $1 million of death benefit year one. If I did invest that $44,000 a year from year one through and including the 21st year, age 65, that's $924,000 that's going to go into this or into the IUL. But in the example of putting it purely into the S&P, netting 4.11 per year, at age 65, I'd accumulate just shy of $1.5 million. In the index universal life policy, due to the power of compound interest without taxation, net of all policy expenses, plus all the death benefit you're going to get, $1.8 million. So now it's time to literally deliver income, selling off the S&P in order to do so. You'll remember this from the previous page. I run out at age 78, but for my 924 investment, I took out almost $1.9 million of tax-free income before I ran out of money at age 78. Taking the same income out of the index universal life policy, when I would have ran out in the pure investment in the S&P at age 78, I still have $1.2 million cash value left over and $1.3 million death benefit. That's going to allow me to provide you, the client, with an additional substantial amount of annual tax-free income from 79 through and including age 90. In fact, that's $3.4 million of cumulative after-tax income, and I still would have $280,000 left over of cash value, not to mention the substantial death benefit. So for the same $924,000 that would have went into the S&P, putting it into the index universal life insurance policy, and taking into account the death benefit at age 90, the total tax-free value to me during my life from retirement years from 66 to 90, 3.4 million. The value to my heirs if I die at 90, 448. So there's a total value to me and my family of 3.8 million, taking it all the way through and including age 90 with death at 90, compared to $1.8 million with purely the S&P. Now also keep in mind that I've had life insurance all the way out. So the difference between the value of the index universal life policy, if I just make it all the way to 90, versus purely investing in the S&P, is almost a $2 million differential with no sleepless nights, no market volatility, because here principal can only go up. It cannot go down when the markets go down. Very powerful story here of why a long-term focus for index universal life typically will outshine, under the same assumptions of rate of return, an alternative investment into the S&P. Now, if we want to see what rate of return after tax and investment expense the S&P would have to year in, year out deliver to match the index universal life, keeping in mind the same $44,000 a year or $924,000 going into the S&P or going into the index universal life policy. If we now wanted to match the distribution phase, the retirement years, in other words, if I wanted to be able to take out all of the income from the S&P that the policy was going to deliver. Remember, the S&P was going to run out at 79. So if I want to match the income out of the S&P to match the income coming out of the index universal life policy, 3.4 million, and assuming that I die at 90 where my death benefit would have been 448, so I need 448 left over in the S&P. What rate of return after tax and investment expense in the S&P would I need? How about 6.31 after tax and investment expense to match? And that will not give you all of the death benefit that you get out of the gate with the index universal life policy. So Mr. Client, with that in mind, what percentage of your low to moderate risk assets and your annual savings do you think you should allocate to this index universal life policy asset class? And you know what they say over and over? 100%.